Hello, everyone, and welcome to another episode of Flipping Out. I'm very happy to have a very special guest on today, Chris Prefontaine. He's out of Rhode Island. He and I are in the same mastermind course, family mastermind, and it is a great mastermind filled with a bunch of heavy hitters. And Chris is a really big heavy hitter that has been in this business for a very long period of time in real estate, between brokerage, coaching, investing. He's seen everything from A to Z. He, like myself, has been through that whole horrible financial crisis. We were just talking a little bit before here about the scar tissue we still have from those wounds. Chris, thank you for coming on. I appreciate it.
You bet, Paul. Yeah, thanks for aging me too with the bit long time in the business. But yeah, I've been around for a bit.
You know, it's good to be an OG. It really is good to be an OG because you're going to be one of the go-to people for when newbies come in. They want to know what it was like, going through that financial crisis for sure.
They should. All kidding aside, they should want to know that, right?
Yeah, it's the most important thing, right? I mean, because we build in a lot of scar tissue. We have changed the way we do business based off that, hoping that never happens again. But there's always a chance of something like that could. So I know I totally shifted my business. So before we get into that kind of thing, why don't we start with how you got started investing in real estate, your background in real estate?
Yeah. So I started in 1991. I'm coming up this fall on 32 years as of this filming. And I started I was in my 20s. So I was actually finding lots, single lots, asking the landowner to let me put a sign on it. And then I would connect with a builder and I'd market a finished package. And everyone, including the landowner and all the subcontractors, would wait until the thing closed. I can't even believe in my 20s that I went and asked people to do that and it worked. But the market was soft, so it worked. And then in the 90s, I started that brokerage I think you alluded to, sold that to Coldwell Banker. It was my only reason to do it. I wasn't excited about doing it. And after that, I coached. Actually, at that time, it wasn't investors. It was realtors earning like gross commissions of like $500,000, million and up. And that was strong in those days. Mm-hmm. And I needed help like just to get their like stuff together because they could produce, but everything else a mess, right? Totally. And then I did my own investments, and then that led up to the lovely debacle that you just mentioned earlier. And when I say my own investments, I don't know, I think I had like 20 something properties. They might have been in the commercial / condo conversion markets. And when the market hit, it was like a light switch went off, and I just couldn't do anything. I got trounced financially and mentally for about 4 years.
Yeah, no, I'm in the same boat with that. And the biggest thing that happened, and liquidity left the market, right? We had nobody lending money for anything. Even private lenders were all pulled back because everybody was just so scared. They're watching the stock market go from 10,000 plus down to 5,500. Right. Actually, it might have been 12,000 at that point that it had gotten up to, but it really, really crashed. And everybody thought the world was ending. And we had crazy amounts of real estate available on the market, right? Inventory was through the roof. I remember buying, I don't know whether you got into bank-owned properties, but that was kind of one of my specialties. I remember going on HUD Home Store, properties that were listed for $225,000, $235,000. I was picking them up for $90,000, wholesaling to flippers for $150,000.
Crazy.
So I don't think we'll ever see anything like that again. Now I got to really, really hunt my deals down to do that. But you got into some builds, right? From ground up. Talk about that a little bit, because that's something that's not for your average, very first time investor, right? There's a lot of moving parts.
Yeah. I mean, I didn't know how to do it either. I hooked up with people in the field that knew how to do it, but yes, that would be a tough go as a newbie. I just wouldn't recommend it. In fact, I don't even recommend fix and flip. I don't know what your thoughts are on this, but now in this market for anyone, it's just, in my opinion, too tight, too high maintenance, kind of one paid transaction versus, as you probably know, we do like a 3 payday thing we trademarked. And I just don't want to do that treadmill anymore. You know what I mean?
It's transactional, right? Whether you're wholesaling and fix and flipping, there's a lot of risk in this market right now with interest rates and everything. So much uncertainty, because if interest rates really were to go up 8-9%, you're going to see inventory really, really increase. And then you're going to see prices really start to come down and won't be stabilized anymore. If vice versa, if the rates drop back down to the 5% range, we're going to have a crazy rabid market again. But the fact is, we just don't know what's going on.
Everybody wants to know that, right? Like, that's the biggest thing. But you and I don't know. The billionaires don't know. The economists don't know. Here's what I do know. And I love your opinion on this. I know the market's going to always change. That's what it does. You and I have been around long enough to see that. So how about we just get really good, like you and I know how to do it now, but we get really good at pivoting, like you just alluded to a couple pivots you took. Get really good at pivoting in our world, creative real estate, to be able to not just survive, but like literally crank through the changes. That's how you get good, not waiting for some change.
That is the absolute truth. And just give you like a little bit of time frame back when I used to pivot from, let's say, 2013 to 2019. Every 6 months, I would look at my business. What worked in the first half of the year? What changes do I need to do? What markets were successful for us? Which ones were not? And we pivot that way. I can't do that anymore. I've got to do it month to month because things change so quickly now in this market. From location, because of COVID pushed people right to different locations. They're leaving different spots. They're moving to the Sun Belt for the most part, but other states as well. So we've got to pivot and look at it every single month and keep on top of the financial news, inventory with what's going on there, and interest rates. There's so many factors we have to look at now that we didn't necessarily have to look at a decade ago. That makes it nerve-wracking.
Yeah, you know what I find interesting? You hear people's, maybe the younger generations, I think, about the interest rates, like they're in a panic. The fact is, I think I'm close on this. I know the average, like 50-year average is like 7. Okay. Well, we're not even there, I don't think, right now. Last I looked. So people panic, and just understand, if you're new or you're younger than us, that the fact is that this is not crazy right now, but it's causing the craziness, and it's causing the media to say all this.
People got so used to that cheap money, 2 3/4 to 4% mortgage that they got
free.
spoiled.
That's like free.
Yep, it is like free. I mean, and my house here, I got lucky and bought it, in around August of 2021. So I got a 3% mortgage on it. It's probably a mortgage I'll never get rid of because it's so darn cheap, right? Like I'll never be able to find that rate again.
I'm in the same boat. My wife asked me yesterday. She said, "What is it now?" And I gave her some current rates. I'm at 3.1 as well. I got a tiny one, but I won't get rid of it.
No, that's cheap debt. It's like almost like an asset. Chris or Jason Hartman, who's in our mastermind group, talks about that. It becomes like an asset because it's so inexpensive, and you can cash flow rent the property. You could do all kinds of different things because of that there.
Yeah.
And getting into the historical rates, you are so right. The 50-year average, 7%. If you look at historically throughout the history of this country, 8% is the average mortgage rate. So we're still below that, and people are going crazy. But there's this psychological barrier that we hit last year when it hit that 7% and just above in late July, or actually early September. People shut down. And then when it dropped back down into 6s and even to the upper 5s for a little bit there, people were right back in there buying again. And I think it's that sub 6 creates the frenzy, but sub 7 just keeps a nice steady flow to the market, nice steady prices. But I don't know which way it's going to go. We really don't know,
Well, here's something cool for the listeners to know, and I'm sure it's known, but if you're newer, how about you go out and you buy as many properties as you can with the rates you and I are talking about, like 2, 3, 4%. And we do that obviously subject to existing loans. So you're not ever going on it personally. One of my rules after the crash, not signing personally, but the sub 2 properties right now are rampant. Some people need to be built out, and we're buying these homes at 2, 3, and 4% underlying debt. It's crazy.
These are the best assets you can buy, and you don't mind paying market value for them because the interest rate makes them so much cheaper than what market value is when you look at it.
Yeah, right? 100%.
And then you can cash flow it. You just got a lot of different options with it. You could wrap it, sell it to another buyer there with a wrap. You got all kinds of different options there. So many different things you can do. Let's talk a little bit about that. What you guys specialize in, if you wouldn't mind.
Sure. So we buy 3 ways. Subject to existing debt is one of them. The other 2 are owner financing and lease purchase. But I'll niche the owner financing down a bit. We almost 100% when we do owner financing, we're doing it on free and clear properties. So it's like we get both ends of the spectrum. A sub 2 seller, as you know, is more prone to, hey, I need financial relief yesterday, help me out.
Yeah.
And an owner financing free and clear is more, hey, I want my best price. I got time. What can we work out for terms? This building I'm standing in, talking to you today, was bought from a free and clear owner, very savvy investor, actually one of the largest landowners in the area on the island here where we live. And he wanted owner financing for estate planning, for tax reasons. And that's what you find with the free and clear. So those make for some really serious 3 payday deals, those free and clear properties, because you're pounding down. We do no interest, Paul, usually. So we do principal only monthly payments on these. And that just hammers principal. It sets you up for sort of a recession hedge, I'll call it. Those are nice deals.
Oh, they absolutely are. And for those people that are investors out there, or people that are just savvy about tax, that one of the big benefits of a seller selling it that way is they're not taking all that taxable income, right, in one shot. They can break it up, which is really, really powerful. It's hard to relay that message sometimes to sellers that people aren't that savvy. But when you get somebody that really gets it and understands, it makes it such a simple deal. And yeah, you can really put deals together. I love your model, the lease options, the owner financing, the subject to. They're probably three of the best out there. A lot better than just your transactional wholesaling, fix and flipping, which you get a lot of risk. And I'll tell you, I'm still doing some fix and flips. We try to do more wholetailing where we do, small remodel, get it mortgageable, then move it, keep that low risk, sell it to an end buyer at a discount compared to what a fully finished product is. And millennials are really going for that. That seems to be the big market. We're going to get there. Plus, we'll probably get some Gen Zs and some Gen Xers from it as well. But that it's higher risk, right? There's a risk of market shift, interest rates going 9 or 10% for people who don't remember the 1980s, like you and I do, Chris. Interest rates got up to 18+%. I think it would have been 21%. I think my grandparents were telling me for a mortgage, which this is like credit card usury rates, right?
Yeah, can you imagine? It's crazy.
It's unbelievable. But, people still bought and sold properties back then. Real estate was still something people did. And people just, now we have a bigger population. We have more people moving. So we probably have more transactions going on, obviously, than we had back during that time.
Yeah. And we exit all these, Paul, very appropriate for post-COVID, but always appropriate. We exit them with a rent-to-own program. But I know, you and I know the names. I won't call anyone out, but there are a lot of people that teach rent-to-own where they put buyers in these homes and they frankly aren't going to cash out, and they know it. So my son runs the buyer side of these things for us and our students. And when they come in, we're obnoxiously picky with the buyers in the underwriting process. So our rate of default's like 2 to 5%. You might get up as high as 10 in a bad year where you get a bunch of headaches or people had life events. But for the most part, those are low default rates for us for rent to own. So we're cashing them out by being super picky with how we, who we put in there. They got to be true buyers. That's how we cash them out. And that's how we create those 3 paydays I was alluding to.
That's brilliant. One, I mean, that's really low fallout rate. Big time. That's big time. That means you guys are doing a great job on the underwriting. You're underwriting like a mortgage is being underwritten.
Correct.
In a sense. Yeah. Right. And that's a way to really secure and make sure you get a great buyer on there. But like you said, life events happen sometimes. I've done this in the past too, and somebody got divorced, and of course now they're definitely not going to qualify because you got one income, and then who's living in there, who's moving. So you run into them on occasion. But when you underwrite it properly, the risk is just so much lower than when you're just throwing anybody in there, and you're going to have like 50-60% fallout rate on some of these deals out there people put together. It's unbelievable.
Yeah, I've heard that and worse. So it's important to know, though. So another key thing with what we just said, okay, say you do have the default. When you have the deals, you're never on these personally. So when you have these deals take a turn, we had an office visit yesterday. Students flew in and they said, hey, we share everything, like the good, the bad, the ugly. We want them to learn from the lessons. And I said, hey, we had this house during COVID. We had literally a professional bad tenant get by our realtor and get in the door. And they used a fake social and everything. I mean, criminal. So they tied the house up for 2 years. So I'm giving you like the worst case for the listeners, not to panic on creative real estate, but this is what happened. Right. And then what do? I called the owner and said, hey, Bob, here's what's going on. Look, I'm not going to default on you, but you need to give us more time, because I got this headache. Or do you want the house back? They don't want the house back. None of these deals. So he said, no, Chris, do what you got to do. And so there's always a pivot. There's always a deal after a deal. And frankly, sometimes it comes out more lucrative. I think that payday 3 on that was like over $100,000, but we had to go through the pain to get there. That's all.
Yeah. And you got the benefit of an accelerating market, right? Luckily during that 2-year period where they were in there. But you probably had the headache of once you got them out of there, then you had to do some work on the property to bring it back up to potentially where you needed it to. Or did you? Was that?
We had a teeny bit. It was not surprisingly not trash, but just wear and tear upgrade. It was a big house, like a $500,000 house. And then we had, luckily during the process, our payments to the owner were low and they were principal only. That's how as I said earlier, that's how we structured. So at least it was like a forced savings. Like we had to pay that in. And at the end, we got 100 plus back. So it was okay.
I love the business model because it really does take risk off of you. You got an option to get out at any point without any issues. I'm sure your paperwork that you get your students, makes it really secure.
We load up all the agreements and of course encourage them to do whatever they need to do locally. But yeah, for the most part, I'm hearing and seeing our basic stuff through our courses being used everywhere, and with small tweaks per state.
Right. Hey, that's right. I was just going to ask you that. I'm sure your students are all over the country. right?
Yeah, West Coast to East Coast, yep. And then a teeny bit in Canada. We got some students that are trying to do some things, not trying, they're opening up things in Canada with us, and so that's pretty cool. But most of the United States, yeah.
So your market in the Northeast in general, and California and some other states like Illinois as well, notoriously tough on landlords. I'm not sure if Rhode Island is notoriously tough too. Like New Jersey, for instance, state right next to where I grew up in Pennsylvania, high end area. This is a beach house. Somebody was in that property, professional tenant, like you said, took them 2 years to get rid of them. They were fortunate because during that 2 years, that property value went up unbelievably because they ended up selling around 2021, which was like peak probably, right? So they did really well. And then the person who bought it tore it down and build a new house. But the point is you can run into these issues where you have that. And some markets are tough to get rid of people. Pennsylvania was definitely easier, but Philadelphia itself, cities are going to be a lot tougher than the suburbs in general. And then there's other states like Texas and Florida where you can get rid of people pretty easily for the most part.
Yeah.
So yeah, you got a paperwork for, I imagine, all kinds of different states to cover people, or at least some clauses and stuff to put in there to protect them.
I think to go back to the original question about the like each state, I always, my student will call me and go, our state's really hot on landlords. I go, they all are, like in some shape, form, or fashion. It's not fun to go through that, but there's always pivots. I remember, here's a quick example. We had a house. My son was in high school back in 05, and I bought the first little building with him, tiny little 2-unit commercial building, smack dab in the middle of a residential, and we were renting it. We had some problem tenants, so the thing was empty, and I'm thinking, what a nightmare. But then what we ended up doing, to fast forward, why I say there's always a pivot in real estate if you just hang out with people that have done it. We ended up getting a gentleman that runs a window business, window replacement, roofs, solid. And he went in there, not only, so I gave him like a master lease purchase because it's a commercial little building. Mm-hmm. He built a building, Paul, that is probably 4 or 5 times the size of the original building. Now, it took me a year or two to get to this point, but he's coming up on his 7th year anniversary of a 7-year lease purchase. And literally, if he was gone tomorrow, that building's probably $600-700 grand. Like, he built a monster building, got all the approvals, did it himself on our land. So there's always a pivot if you just stay in there and kind of chat with people that have been through it,
Oh, absolutely. When there's a will, there's a way. You'll try to figure out. There's always a way to solve the problems. Maybe finding the right people, like you did there, find the right people to talk to, what direction to go. But now he has built a huge asset on your property. If he defaults or something goes bad, you are sitting pretty for sure.
Yeah, God love him. I like what he did, but I think his attorney's already calling because August is his end and he wants to close it out. And I'm happy for him.
Yeah, no, it's good. It's a win-win. It's a win for you. It's a win for him. So it's a no-brainer.
Yeah.
Speaking of commercials, so you do some commercial deals. What do you do, like a decent percentage of them, or just dabble, whatever the market gives you?
Yeah, good question. So we teach, broad. We teach single family because I just feel like if I'm from the I'll say from the stage, but from teaching standpoint, you start teaching other stuff to especially new people, and frankly, it's the shiny object syndrome, right? Well, I got to go to that. You can buy, as you and I know, owner financing substitute. You can buy any asset class. You can buy a boat and a plane or a car, but we stick with single. And then while they're prospecting the students, and while I'm doing my thing and my VAs are bringing in leads, I run into stuff, right? So if it's a 10-unit or a 6-unit or this building, then sure, I'll look at it. But because you can do anything creatively, anything.
Yeah, absolutely. And I think commercial leads even more so to creative financing, just because especially right now with what's going on in retail anyway, in a retail space. I'm really curious to see what's going to go on with the big multifamily for these people have these 5-year rate resets right now.
That's what I was going to say. Yeah.
That's going to be risky. I'm into this smaller multifamily, which it has some advantage. Like I have 12-unit, 5-unit. I can get 30-year fixed on those. So that reduces the risk for sure. So I'll be curious to see how that plays out. We know retail and office space are really going to get crushed, and industrial is still really, really strong and in demand though. And of course, retail or commercial residential apartment complexes are still in high demand. But the question is, can they get enough increase in rents where they pretty much already squeezed the orange and got all the juice I think they can out of it in this current economy before we start the turn here? I'm curious to see how many of those are going to go bad too. What's your thought on that? Do you have any idea on that?
Just my opinion. I think from all those categories you mentioned, because I'm sitting on this building, that the office space is probably in my brain the more scary, if you want to use that word. Only
Agreed.
because you got, and I'm hearing feedback as people are showing my building here that all the small office space market is like dead, at least where we are because of COVID. Like everybody went home, right? I used to
Yeah.
have 15, 16 people here. Now I have 25 on my team all around the country.
Mm-hmm.
So, and then I had a tenant here that was here for 30 years. So they predated me and the past owner, and they just closed down. So I think the office market's tough. And then the same people showing my building said, hey, Chris, the construction companies and landscape companies around here, they love your building. So it just depends on where you are and what type of properties are in there. As far as I think your last class you were talking about was the apartments, right?
Yes. Yeah.
I mean, I know that there's even builders right now building large communities and not selling them, entire rental community. So there's pockets in there that are certainly advantageous. But I kind of hang out where my properties are personally, which is they're usually hot areas, right?
Yes.
Whereas my students are all over the country.
Yeah, no, I mean you're in a good spot. Rhode Island is it's a small little island. It's all pretty much highly desirable area to be, right? In Rhode
Near
Island
the
for sure.
water. Yeah. Yeah.
Yeah, because you're close to the water. You're just in a great location. I think anywhere geographically in the country close to water is always going to do pretty well. Even look at California, which has the most extreme taxes and everything on it, and people still want to be there, even though for the first time ever over the last couple of years they're losing more people than they're gaining. It's still a desirable place, I think, overall for people to be climate
Yeah,
wise. All that kind
I
of stuff.
agree. Especially if you're doing something in some of the categories you mentioned, like the fix and flip or the build or personal property. Like just if you can get close to that. Like I was told by a realtor here locally, I'm on like a peninsula, and they said, Chris, during the crash, like this was the only area where they were selling homes anywhere near $1 million,
Yeah.
because now it's multiples of that because of the water.
Yes, the water just makes a huge difference. We're fortunate enough. We have central New Jersey, Bay Head, New Jersey. We have a shore house. It's like a block and a half off the beach and a block and a
Nice.
half off the bay. So the location's great. It's a typical Northeast old house. It needs everything. It's still got some knob and tube wiring in it, believe it or
Oh,
not.
lovely.
Yeah, eventually at some point we'll want to renovate that, but I just have trouble pouring money into and that's I call that one more of a liability than an asset because we don't rent it out. We own it jointly with my wife's sister. I inherited that property. So because of that, we don't rent it out. It doesn't bring any income. It's just liability. So I'm hesitant to put much money into it. I'd rather put it into deals that are going to bring a return.
I don't blame you unless you start Airbnb in it or something. I know you could.
Yeah, we could Airbnb in that would be great. And those monthly rents in that area, they go for like $15,000 to $30,000 per month for June, July, August, right? Really more so July, August, September, you get a decent rate as well. But everybody is usually going back to schools at that point. So you lose the families. You're just going to get the people who don't have kids in school at that point.
Yeah.
But
Yeah.
you have nothing in the wintertime. Now, nobody in the Northeast wants to be right by the beach necessarily. It's not a pleasant experience.
Yeah, and you're not getting out of towners in the winter. That's for sure. Not there.
No, not at all. Down here in Florida, you'll get it all year round, which is good. But you're paying for it depending on where you are, especially if you're on the water. That is for sure.
Yeah, yeah.
So you exclusively are in Rhode Island. Do you do any other markets? Just out of curiosity.
Our family business. So our business here locally is myself, my son-in-law Zach, my son Nick, and a great team.
Mm-hmm.
We do things in Rhode Island, Mass, and Connecticut. And that goes way back to post-crash where I was in Rhode Island and my leads just weren't enough. So I started, branching out and ended up being like 60% in Connecticut, like quickly. Wow. And then our students are all over the place. So we get kind of I look at our community, Paul, like the Wicked Smart community is like a microcosm of society because I have a mix out there in all the markets. And when they give me feedback, I at least get a pulse for all the markets. But we stay with our family company just in this tri-state.
That's great. And I completely agree with you. We have students all over the country as well. And it is really good to know what's going on in different markets that I'm not in. I have bought in 44 to 50 states, but I'm really only active in about like 12 to 13 right now that I really pinpointed, really like, want to hold long term. And other ones I'll just occasionally flip in. But it's interesting to see like states like Illinois really falling at this point. If you look at it, it's kind of correlated to the markets. Last year, the NASDAQ crashed. So the tech market crashed. So any of those areas residentially around the tech space, like San Francisco, and even in Denver, Colorado is still feeling it as well, too, because that became a tech hub. Raleigh, North Carolina, Austin, Texas, those markets are suffering more so than other markets just because of the sector, right? And then we got to look at it sector wise, right? So if depending on what particular type of business has high unemployment, depending if that's area dependent, those are markets we're going to want to kind of avoid for a little while, right? Because rents will be falling, real estate values will be falling, but tech sector is kind of broken out in different areas where it used to be just California for a little while.
Yeah, those are all those areas you said are at the same time right or downers for the listeners, because like we just did a house in Colorado, and I said this area, but we'll have a student call and go, hey, Chris, I'm really not in your program, but I got this deal. I don't know how to do it. So we'll do them. And we just closed one in Colorado, and it's with a sub-2 with a low interest rate. So those areas that you said, that might be something worth writing down for the people to go, oh, okay, crappy for the conventional market, but how about I watch it and look for people that need to bail out and that they can.
You're exactly right. That's the markets you want to focus on for that opportunity. It's going to be much easier to get them there than at a red hot community where the people are going to sell to a cash buyer or sell to somebody who,
right?
Because there's so many buyers and so few sellers. Very, very key point. And this is something I've been pushing, even though we specialize kind of in the bank owned stuff and online auctions. Yeah. We do tell our students, look for, especially when you make relationships with agents, realtors, and you want to find those people who need to sell and because of some kind of hardship where you can take over that existing mortgage that's subject to, because I'm willing to pay, if something's on the market for 300,000, I'm willing to pay potentially more than that to get that debt and maybe give them some walkaway money and also pay the agent and get rid of that headache for them to take that over. So, but it's got to be in markets, right?
Yeah, I agree. And so you can pay a premium on owner financing too. If you just picture it, I tell the students, you could be sort of like 3 to 6 months worth of your monthly principal payment. You can be that above their ask price. So for example, if I was buying a house, we bought one in Cape Cod, Cape Cod, we bought one on the water, and we bought it from a realtor, Paul, not just a regular seller. She couldn't sell it. She's a Boston realtor. We bought it for just under $1 million, like $945, $2,500 a month, principal only payments. She was a little lower than that. But I said, okay, in every 4 payments, I got 10 grand off of principal. So I didn't mind going like 10 or 20 over ask to get the property, to get the right terms. So yes. You can do what you said with sub-2. You can do it with owner financing for sure.
Yeah, especially those desirable properties, like anything on the Cape, right? The Cape is going to be so desirable, a red hot spot. Yep. You don't mind doing that. When you're paying just a principal like that, you are just hammering it down and you're getting your money back pretty quickly when you look at it from that perspective. I love your business model. I love what you guys got. I'm pretty sure you have a YouTube channel like I do too. I'm going to have all the links. If anybody wants to get in contact with you for your coaching program, why don't you tell us the best way to do it? I think we do have it streaming at the bottom here, but if you want to give the best ways to contact you for that.
Yeah, so just the smartrealestatecoach.com that you have. Thank you. And then I do have, do you want me to give the book link out?
Oh, yes, do the book. Let's talk about that one. You got a free book.
Yeah, we're going to give the bestseller book out, and we usually throw 2 in. We got 3 or 4 of them. But here's the thing. It's not one of those offers that they annoy me so badly when they go free book and I click all the way through and then it makes me put a credit card in for shipping. Right. So no shipping. We literally ship it out of this building downstairs. Sue, we're going to ship it out to you. Just go to wickedsmartbooks.com/out, OUT, wickedsmartbooks.com/out. If they can deal with my New England accent, Paul, for another hour, they can go and take my free master's class. The reason I'm big on free, and you mentioned YouTube, is I want people to, if they want the niche that we're in, creative real estate, I want them to at least know that. Like, don't come in to dip your toe and come in because you go, hey, I looked at all your free stuff and I want to learn this. So if you want to go to the free master's class, it's just smartrealestatecoach.com/master's class. That's it. Simple. And I'll see you on there. It'd be fun.
That's awesome. And we'll have all the links. And here, if you're watching this on YouTube, you'll see all the links and the show notes and everything there. And the same thing on a podcast there. You'll be able to contact Chris at any point here. I love your program. I love what you're doing. And I think it's very timely with where we're going here with these low interest rates that we've had. And we may never see these again. And you want these assets. These are going to be the greatest assets you're ever going to have. Right. And you got a lot of different ways to make income from it. And like Chris said, if somebody goes bad, not necessarily a bad thing. Bring a new tenant buyer in. You're keeping that. If it was a lease option, you're keeping that non-refundable deposit, right? Same thing as tenant buyer, you're keeping that deposit. Right. And then you do the same thing again, rinse and repeat. But there's a chance the property's worth more, so you can even get more in a monthly payment and charge more. So I love this business model.
Well, thank you. Appreciate it.
It's awesome stuff. All right. Thank you, everyone. We appreciate you, and we will catch you on the next episode.